Expectations are at fever pitch for Nvidia, but will the company live up to them? Welcome to Market Insight. I'm Elena Casas. Chipmaker Nvidia is now the third largest company on Wall Street after a stratospheric rise of 87% year to date, put it in the $2 trillion club, behind only Microsoft and Apple. It alone has been responsible for 37% of S&P 500 earnings growth in the last 12 months, and analysts are expecting similarly blowout numbers when it reports tomorrow. Well, for a look at what to expect, let's ask Eric Lynch, Managing Director at Scharf Investments. Eric, hi. What will you be looking out for then in Nvidia's numbers tomorrow?
Yeah, I think more of the same. As you had mentioned, the trend has been stratospheric. Analysts are expecting, $24 billion of revenue. That's basically 235% year-over-year revenue growth. So I think the quarter is going to be really strong again. The real question, Elena, is what's the guidance going to be? Because the next quarter is quite interesting, and here's why. In 23, the quarterly jump from the quarter ending in April to July, the revenue grew sequentially almost 100%. So this is the last quarter where you have a pretty easy comparable before the giant step change. Next quarter is where the real fun begins to see what this business can really do on a run rate going forward.
Do you think it can continue growth at this level? I mean, clearly Nvidia got a jump technologically on the most capable AI chips, but competitors are coming up fast behind, aren't they?
Yeah, trees don't grow to the sky as strong and beautiful as this tree is. There's a lot of competition. We're based in Silicon Valley, and I can assure you that there's a lot of engineers talking right now about how they can snatch those gross margins from Nvidia. And it may take a few years, but it eventually happen. The other issue, another big question mark, Elena, is, to date, most of this demand has really been development driven, i.e. it's really to get large language models trained. It's the data centers, the hyperscalers, cloud, AWS, Microsoft, and the like that are buying this stuff for development purposes. Eventually, this needs to transition this phenomenon from development to real production, use cases that are used by corporations and consumers. And if that doesn't happen, then clearly this demand will have to slow, and you'll get a classical cyclical downturn in semis, even Nvidia.
Are you saying then that investors should be careful with this sector going forward?
They should be careful. Just to remind everyone, 2018, Nvidia shares were down 31%. 2022, they were down 50%. And that's really not that's not dissimilar from about half the semis this year, which are also getting a cyclical hit. So semis are great until they're not. This is clearly a long-term kind of structural dynamic new phenomenon, so maybe it lasts a little bit longer than the typical cycle. But still, the classic boom-bust semi-cycle will probably continue, which is too much, demand's not kind of correctly calibrated by the company's supply. They've had too much inventory, they write it down, and gross margins get slammed and earnings go down. So it's just a very tough thing to calibrate supply with demand for semi makers.
I have to ask you also, Eric, about Fed policy, of course. The minutes of the last meeting are also out tomorrow. They are very backward looking, but what do you think we'll see? Policymakers remaining very cautious in tone?
Yeah, it's a good question, Elena. We all kind of are obsessed with this the last couple of years, and for good reason. It's really been a primary driver to stock market returns. I expect it to be more watchful waiting. The Fed's between a rock and a hard place. It would like to reduce rates and keep the economy strong. However, it's really hard to do that with persistent inflationary rates. We had a nice reading in April, but that was the first one in many months. And if you look at the Fed speak, both from Powell last week and even from Waller today, it's very much a message of, hey, we need many months of this before we feel comfortable. And I think the reason why they're saying that is there's a bunch of inflationary pressures that the Fed does not control with monetary policy. This is not the economy and conditions that we had 2 decades ago. This is a whole nother set. We've got tariff pressure, we've got fiscal deficits in the US, We've got deglobalization, supply chain pressure, geopolitical risks burgeoning here this year. So a lot of things I think the Fed's not mentioning, but that gives them pause for concern to get too excited with rate cuts.
We are seeing some signs, though, that the high cost of credit is weighing on the American consumer. So how risky is it now, do you think, that they may choose to wait too long to cut?
It's definitely a risk. It's a great question because you're starting to see cracks, maybe too strong a word, but you're seeing a slowdown. And, getting back to Nvidia, if you take Nvidia's expected earnings blowout out of the S&P 500's growth, year over year is looking like 3.5%. So earnings growth is okay, but it's certainly not fantastic. And you're seeing whether it's Target or Walmart or McDonald's, Lowe's today, all are mentioning that the consumer is trading down, the lower income consumer is particularly impacted. What was kind of interesting was yesterday, Elena, JP Morgan had an analyst day, and Jamie Dimon said we're even seeing the high-end consumer starting to slow down their discretionary spending in things like retail and luxury. So you're seeing a slowdown. Retail sales were flat in April, month over month. The Fed is truly between a rock and a hard place, trying to manage their dual mandate.
Lynch of Scharf Investments, thank you so much for that analysis. Well, that's your market insight. You can watch more videos on Reuters.com.